The Wolfe Wave Trading Pattern is a structure that Bill Wolfe discovered after reading a technical analysis book by Edwards and McGee, and he found one chart pattern exceptionally reliable. And in technical analysis, this pattern is called a wedge. And a wedge can be both a continuation pattern and a reversal pattern. So after studying that wedge, Wolfe concluded that everything you need to know about space and time was discoverable with a few trend lines. I take this with a caveat, I have to admit, and I'll explain at the end of the short presentation that I have for you guys, but this pattern has been very influential in my trading, and I will explain to you why shortly. So, although we'll see the Wolfe Wave trading pattern in this video, note that this price behavior has been identified by many chartists who gave it a different name, basically, with different rule sets. So for instance, Larry Pesavento describes the pattern as 3 pushes to a top or 3 pushes to a bottom, and he uses Fibonacci relationships to confirm the setup. Jeff Cooper calls it Cooper 1-2-3 swing, and Linda Bradford Rashke calls this setup 3 Indians. And where the Wolfe Wave separates itself from the rest of the pack, so to speak, is that there's an objective target projection. So let's start by defining the bearish Wolfe Wave. The bearish Wolfe Wave trading pattern is identifiable once 4 points have been marked on a chart. And from there, we can trace a line from the swing highs of points 1 and 3 to get our resistance line. We can then trace a line from point 2 to point 4, and this gives us our basic wedge. Now we wait for price to accelerate beyond the resistance trend line at point 5, and at this point the trader needs to decide if he will fade the trade, meaning that the trader doesn't wait for price to get back inside the wedge to establish a short position. Fading the trade entails more risk of failure since the market hasn't confirmed that it is weak, so the upside is that there is more potential profit if price reverses. The other safer option is that a trader enters a short position once the price shows signs of weakness by returning to the wedge. This could also be called a false breakout or a bull trap because everyone that went long above the resistance line is now in the red. So from there, a vertical line is traced from the wedge's apex towards the bottom of the chart. And this is called the ETA, or estimated time of arrival. We then trace a line from points 1 and 4 and extend it to the ETA line. We now have the EPA, which is the estimated price of arrival. By connecting the two lines, we now know at what price we will liquidate and approximately how long it will take before prices get there. For the bullish Wolfe Wave, everything is reversed. So the resistance is drawn from point 2 to point 4, and the support is drawn from point 1 to point 3. But aside from that, the concept is exactly the same. This pattern has been very influential in my trading. And even though I don't use the ETA and EPA because I don't find them reliable, I still use the framework to help me to find long-term trading opportunities that I can then scalp for several days or several weeks, and I'll show you some examples of that. So JD's on an uptrend, and we have this structure here. Basically, you have these two highs, two lows, and you have this supply shift here where price goes too far, too fast, and then comes back in even with a big gap. And by connecting these lines here, the high from here and the low, you still get the a target here as far as price. Not time, because you would need to have the wedge to be closing and then reaching itself. And this is why I'm not a big buyer of the entire Wolfe Wave thing. But I do like the concept of the supply shift, the fifth wave going further from this and then coming back in. This is why I see the some of the components of the Wolfe Wave to be in line with the Wyckoff. I see them as complementary, basically, and they are a big part of how I find opportunities in the markets. So these were the examples that I wanted to show you guys. I have plenty more. I can find you, like, there's one on that come to mind. I have a few on. I have one on uranium, Ethereum, way back, a few years back. Silver. Let me show you actually what I mean. All right, so I don't want to harp on this too long, but real quick. You see this wedge over here, and it's got a supply shift, and then it comes back in. So I'm using, it's not a Wolfe wave, basically, but it is a wedge with a supply shift, and then it comes back in, and then from there prices went way up, and the same type of thing happened here on silver, and if you would go back, like I have several trades of this, all these green lines were places where I bought some of the silver, um, and it never went all the way to where I thought it would, but I had time to make a bunch of money on the way up, and then I gave some back in this zone, but eventually I got out of the trade, but it was a huge win for me. That trade made my year, I remember back then. But basically you had this structure where you had the first wave, second wave, third wave, fourth wave, and fifth wave, and then it went beyond and then came back in, and this was another opportunity. And then you have a similar thing with Ethereum with 1, 2, 3, 4, 5, and then it goes beyond, and then it starts the the boom over here. So no, I don't trade the Wolfe Wave with the ETA and the EPA, but it taught me how to trade wedges and how to trade supply shifts. And this is what I want you to remember from that pattern. So I hope you guys enjoyed. If you did, leave a like, and I'll see you in the next video.